Hello everyone, and welcome to this week's edition of our weekly coaching, or actually our every other week webinar. I guess I'm putting myself ahead of myself. I have a webinar coming up at 3 that is my weekly coaching webinar, but welcome to our main webinar today on how your Experian and Equifax business credit scores affect your business. Today what we're going to be doing is jumping in and dissecting really Experian and Equifax's business credit scores. I've done a separate webinar before on Dun & Bradstreet's credit scores. They have a lot, so it required a full webinar just dedicated to their scores. And after doing that, I had so many requests for people that wanted to hear more about Equifax and Experian's credit scores, both their main credit scores and diving in a little bit deeper to their less popular scores that very few people know about and how those affect your business. So I thought that was a perfect topic for a webinar, and today that's exactly what we're going to dive into. Is we're going to dissect these Experian and Equifax credit scores so you can see what kind of impact they have on their business and what you need to know about them. So before we get too far in, let me first introduce myself. My name is Ty Crandall. I'm actually the Director of Business Services here at Credit Suite. What I do is help companies offer business credit and financing to their clients, and in doing so, I don't know the number, but it's like 10,000 people now. I've financed a lot about the topic of business credit, and definitely know a lot about the topics of business credit scores. This isn't going to be any kind of pitch webinar. I'm not selling anything today. It's just going to be an hour of straight content and information. If you're attending the webinar all the way through, then we will send you a playback of the webinar too, so don't feel compelled to write down everything that you see here. Some of the slides have a lot of words, so I will send you a playback, and then with that playback you can rewind and stop and pause and take any additional notes you might not be able to grab here. And if you are interested at all in building business credit for yourself, or getting financing for yourself, or offering it for your customers and making a business out of it, or even offering it as a secondary service, feel free to check us out online, creditsuite.com/business credit. That's creditsuite.com/business credit. That is the only pitch you will hear from me today. So let's go ahead and jump in. Business credit reporting agencies. Well, there's 3 actual main credit reporting agencies in the business world. The first one is Dun & Bradstreet, which you've probably heard a lot about. Dun & Bradstreet, they're also referred to as D&B. They are by far the biggest player in the business credit space, and they are the longest standing business credit reporting agency in existence, period. They were around about 50 years before the first consumer credit reporting agency, and they completely dominate the industry when it comes to business credit reporting. They have over 210 million records right now on file, and from what I've been able to track, they're picking up about 1.5 to 3 million more every single year. So they're massive. They have a lot of records on file, and they're growing at a pace that no one will ever be able to catch them. The next closest one, which is one that we're going to dissect today, is Experian. Experian has about 27 million records on file, and they're a big player in the business credit world. They're one that you really want to know a lot about, and we're going to spend a lot of the webinar today talking about Experian over Equifax because Experian is such a dominant player in the business credit space. As a matter of fact, Citi, one of the biggest underwriters of business credit accounts is Citi, and Citi Experian is who they mainly report to. It's mainly who they pull also for approvals. So they rely heavily on Experian, as a lot of people or a lot of other companies or credit issuers in the business credit space. So we spend a lot of time on them today. And then Equifax. Equifax is really a non-player. I've never really researched how many records they have on file. Honestly, I don't think I've ever really cared, just because they are such a small player in the business credit space. For every 10 business credit accounts that I see, one of them might report to Equifax. The other 9 are reporting to Experian or Dun & Bradstreet, or a combination of the two. So Experian, Dun & Bradstreet, you really want to know a lot about. Equifax, you don't need to know as much about because they're not a big player, but you do need to know enough about them to build your business credit with Equifax, because some sources rely on Equifax or pull Equifax and D&B and or Experian, so you don't want to have a lopsided credit file. You'd always want to make sure you're building your credit with Equifax, but not as big of a factor as other people pulling information about your company won't look at Equifax nearly as much as they would look at Experian and Dun & Bradstreet. So Experian Business. Experian focuses on providing quality data and analytics for businesses to help them better assess risk. So again, the main reason for credit reporting is to be able to provide information to those people issuing credit, issuing loans, even suppliers. What's different in the business credit world than the consumer credit world is anybody can access your business credit. Like anybody can access it. Like right now, you could tell me your company name. I could go online and pull your business credit report within 2 minutes. As a matter of fact, I could log into my own Creditera monitoring report and I could pull up your company in 30 seconds and know how many trade lines you have, what your Experian credit scores are, all these type of things. This data is readily available. So you want to know that because this isn't just lenders and credit issuers that are pulling this data. This is people that you do business with. This is your customers. People like me that know how easy this is to do. I pull business credit on everybody. Anybody I'm doing business with nowadays, I'll look at their business credit report snapshot because it gives me a quick overview of who I'm dealing with. Is this a massively big successful company? Is this somebody that's just a startup? Is this somebody that's established but has never even taken the time to build their corporate credit? This information is readily available. So Experian's main goal in the business credit world is to provide information to those issuing credit or making decisions based on this actual credit information to help them better assess risk. Now, they possess a lot of consumer data and commercial data that they manage to help businesses obtain the best and most up-to-date information. And a little bit later, you're going to learn how they combine this data. That's one of the things that Experian really prides themselves on, is they're the only credit reporting agency that combines their consumer data with their business data to try to give them an edge. And they have to, because D&B dominates the market. They are the dominant player in the business credit reporting space, so dominant that Experian will never catch them. So Experian needs to stand out. They need a niche. They need to stand out and be different and unique. And since D&B is not in the consumer credit scoring world, then it's easy for D&B to be able to combine consumer and business credit to assess risk and use that as one of their stand-alone benefits that only they can provide. So they have a lot of this information for consumers and a commercial database of businesses that they often combine to actually come up with their business credit scores. And then they extract a lot of information from this data by applying their own analytics. Okay, and some of the stuff is called firmographics, which is something that D&B also prides themselves on. So they use their own analytics, their own technology to analyze all of this information that they then receive, and they come up with a number of different credit scores, which we're going to look at, which are used for different purposes to assess a business's risk. So use both consumer and business credit information to gauge risk. This is one of the things I just mentioned. And from Experian, here's a quote: by combining personal and commercial credit information in one report, Experian provides a complete picture of the creditworthiness of small business. Now, why do they do this? Well, I already mentioned one of the reasons, to stand out and be unique. But another reason they do this is because they've got some very interesting statistics, which we're going to dive into in a little bit, about how they can better evaluate risk by blending these two together versus just looking at business credit. And again, don't get me wrong, their business credit score, their main business credit score in the business credit scoring world doesn't really focus on this blended model. It is just a business evaluation. But it is one of the things they pride themselves on and promote, that they can and do have the ability to do both. Experian is listed on the London Stock Exchange and in a constitute of the FTSE 100 index. I think this is interesting because a lot of people think and believe that Experian is in the United States. That's not true. Their corporate office is not in the United States, nor do they trade on the New York Stock Exchange. Dun & Bradstreet does. Okay, Dun & Bradstreet's actually in Short Hills, New Jersey, and they're actually trade on the NASDAQ. But Experian does not, or actually they trade on the New York Stock Exchange, excuse me, but Experian does not. Experian trades on the London Stock Exchange. They don't even have their corporate headquarters here in the United States. So let's take a look just at kind of what Experian does. Well, last year they did $4.7 billion in revenue, and about half of that, 48%, came from North America. Now, as you're about to see, They did significantly more business in North America than any other country, especially well beyond more than double what they do in the United Kingdom. And there's a good reason for this. It's because of identity theft protection. That's really what this comes down to. In the United States, the bureaus have done an extremely good job of messing with statistics and data and promoting identity theft as a major problem in this country. Am I saying it's a major problem? No, it's not. The reality is the statistics that support that identity theft is a major problem in this country in large part look at errors on these business credit reports from data being mismatched onto the wrong people's reports. So if you really break down these statistics on identity theft being the biggest crime and this biggest growing crime, it really hasn't grown substantially. What has happened is there's a more and more occurrences of Mr. Jones, or let's say David Jones's information getting merged with David Jones Jr.'s report, and now all of a sudden they call that identity theft, but it's not identity theft. It's Experian putting the wrong person's data on the wrong person's report. But in doing so, they've been able to create this multi-billion-dollar industry in the United States, which is identity theft protection, and done a very good job of promoting your need for getting a credit report tied to the problem of identity theft and preventing identity theft. These other countries haven't fallen for that like they've got done here in the United States. So as a result, the next biggest country that they actually do business in is Latin America, or biggest sector that they do business in is 21%. The UK, their own home country in Ireland, 19%. Which I guess, according to a vote coming up here soon, I might have to separate these and create these as two different countries. But at this point, UK and Ireland are only 19% of their total revenue, considering that is their home base, and they even trade on the stock exchange in London. And then you actually come all the way down to Asia Pacific, which is 12%, which is the same way with all reporting agencies. When it comes to business reporting and consumer reporting, it's just not that big in Asia Pacific. It's always the lower level of what all the bureaus do. But again, very interesting numbers, because it goes to reflect that if most of their money is coming from North America, nearly half of it, whereas all the other places they are combined across the world basically accumulate to the other half. So Experian's headquarters is in Dublin, Ireland. I already mentioned this. Okay, this is where their home base is actually out of. They're not here in the United States as many people believe they are, and their business records are spread over 80 countries that Experian services. So of 80 countries they service, North America, this continent, accounts for half of all the business they do, considering how many other countries that are out there that they service. Experian reaches 4 main geographic areas: North America, Latin America, UK, and Asia Pacific. And we just looked at what portion of the revenue comes from each of those actual areas. So a typical Experian business credit report is going to include a company's registration and ownership details, trading addresses, how quickly the business is paying its bills, your pay history, a credit risk score, or more than one credit risk score. Okay, as you're about to see, there could be several different credit scores that you could actually obtain on an Experian report. With Dun & Bradstreet, you'll get 5. If you were to pull your D&B report, it would have 5 different scores, much different than in the consumer world where your report would only have 1 score. Court judgments and other public records, history of financial performance. There's also items include business background information, company financial information, credit score and risk factors, banking, trade, collection history, liens, judgments, and bankruptcies, and UCC filings. So all of this kind of stuff is what's readily available on your business credit reports. And again, what's very interesting to know is that anybody can get this data, anybody that wants it. It's not like in the consumer world. Like if I want to know dirt on you, I can't go pull your credit report. Like I don't have that ability. You can pull your own. A lender that's issuing credit can. And if anybody were to pull your credit without your permission in the consumer world, well, that's a violation of the Fair Credit Reporting Act, and the fines on that, especially in California, could be very steep, $5,000 to $10,000 per occurrence. So very, very, very steep fines with that. You just can't do it. But in the business world, you can readily do it. It's accepted. Anybody can pull your business credit reports and information. That means all of this information I just showed you, anybody that wants it can get it. Your customers, your competitors, anybody. that wants this data can get all of this information. And here's just a quick look at a snapshot synopsis of your business credit report. This is an actual Experian business credit report, so you can see how some of the data lays out that we've talked about here, from their address, phone number, their parent company, parent headquarters, up here industry, their SIC code. These are industry codes to identify the industry that they're in, when they were established, how many years they've had credit on file, years in business, how many employees they have, what their sales are. Okay, you got to think about this. In Florida and in most states, we file annual reports every year. And those annual reports say how many employees we have and what kind of money we generate. All this information then becomes public record. So it's very easy for these reporting agencies to grab that information and put it in your credit report. So keep that in mind. Every time you go to fill out an annual report, you must keep in mind that this information is going to be readily available for a lot of people to view. Not just if they go to your state to try to find it, but it will be readily available in open view for anybody that's looking at your business credit reports. Days beyond terms, your highest bank balance or your highest credit balance, your lowest credit balance, all different type of information. It's kind of interesting because the other day I looked at Walmart's. Again, I can pull anybody easily. So I looked at Walmart's information, and Walmart's highest trade limit was $50 million. So I just thought that was pretty cool because it's not something you see on an average business credit report. But again, anybody can access that information. I can tell you that Walmart has about 514 payment experiences on their Experian credit report. It's easy. It's public information. Anybody can get it. So again, keep that stuff in mind when you're actually keeping track of how you're managing your own credit that reports to the business credit. Is unlike consumer credit, anybody can get it. Here's a look too at one of the main credit scores right here, the credit ranking score that we're going to dive into a little bit later as it appears on the actual business credit report. So Intelliscore, well, Experian's most recent score system is known as Intelliscore Plus. This was actually released, I think, in 2008. Before that, they just had Intelliscore, which was completely different, as you're about to see, and I'll get into as we dive in a little bit deeper. Intelliscore Plus is their newest model that they boast is like the whole new level of business credit scoring. It was released in 2008, and it takes into account hundreds of variables, about 800 variables actually, to offer a business credit score between 0 and 100, with 100 being the high score. Okay, so this is advertised as the highly predictive score that predicts a very detailed and accurate reflection of a business's risk. And Intelliscore actually predicts a business's risk of going seriously delinquent, which they define as over 90 days late, or having a major financial issue such as a bankruptcy within the next 12 months. So, very important to note here. All business credit scores, all three main business credit scores, D&B, Equifax, and Experian offer, are based on exactly the same way. They're all based on serious delinquency, as defined as a risk of you going over 3 months late, 90 days late, in a 12-month time period. I bolded 12 months because the consumer world is 24 months. Just interesting to know that in the consumer world, they're gauging your risk of defaulting over the next 2 years. In the business world, they're gauging your risk of defaulting over the next 12 months. And defaulting is considered over 90 days late. So the 0 to 100 score is a percentile score that reflects the percentage of businesses that score higher or lower than the business being looked at. So for example, if the business has a score of 20, this would mean that the company scores better than 19% of other businesses and worse than 80% of other businesses. Ladies and gentlemen, this is huge. This is a big difference. You see, Intelliscore, just like Dun & Bradstreet's Paydex score, didn't used to be this way. It used to just look at your payment history. That's the way D&B's credit score is. That's why I love it, because if you pay your bills on time, you get a good score. That's all you have to do. Intelliscore used to be the same way. Now this Intelliscore Plus in 2008 has changed the game completely. It's more resemblance of the FICO score with different sections that comprise the overall score. But the main way that it's looked at is this is where you score in relation to other businesses. Okay, so for example, if they're looking at other businesses in your field and 80% of those businesses have whatever score, then that's where you tie in. If your score's 20, where do you tie in with all the overall businesses? If you're 20, that means you're better than 19% of other businesses. It also means you're worse than 80% of other businesses. And here's a quick look from Experian on their Intelliscore and kind of how it relates to risk. So somebody that has a good score of 76 or higher is a risk class of 1, very low risk. A bad rate, which kind of ties to their default rate of 1.7%. 51 to 75, risk 2, low to medium risk, 4.4% bad rate, and so on and so on. All the way here to 1 to 10 is your score. You're very high risk, a class 5, and your bad rate's 50.8%. So look at this. This is a big difference, right? Their low risk has a bad default kind of rate of about less than 2%, whereas on the opposite end of the spectrum, the default rate's almost 51%. Big difference. You can also see here that they break this down into classes, which you might see on the credit report, just to help somebody more easily define the actual risk, right? Because like a lot of you on here, maybe not, are financial-minded people. And if you're good at financial stuff, well, then this score's fine. Like this makes perfect sense. But for somebody that has like no financial knowledge, like they're not versed on this, telling you the score is 27 might mean nothing to you. But if I tell you, look, on a scale of 1 to 5, with 1 being the lowest risk, this person's a 4, well, anybody can easily figure out that that's a pretty high-risk situation. So they break this into risk classes just for anybody to easily be able to gauge the risk, not just based on the score, but the actual score class that they're in. So there are 2 exclusionary scores, which is what they call them. A 998, it happens when a bankruptcy has occurred within the last 2 years. So if you're saying, look, Ty, I know you said the score goes 0 to 100, and I have a 998. Do not go celebrate because you are off the scale high. This is not a good thing. If you have a 998, it means you had a bankruptcy on your report in the last 2 years. If you have a 999, it just means they can't score you. Like there's not enough information to score you, so then they'll give you a 999. Now it's possible to not even have a score if they don't even know you exist. So in a lot of cases, a lot of people, I've been in business for years, and they've never done anything regarding anybody reporting data to Experian. So Experian doesn't even know they exist and might give them a 0 score. But if they know you exist but don't have enough information to score you, you can end up with a 999. So Intelliscore is already being widely used. Many of the largest financial institutions use them. Over half of the top 25 P&C insurers and most major telecommunications and utility firms. They're very big with Experian. Telecommunication, utility firms, insurers have always been very big with Experian over D&B and Equifax. Transportation, manufacturing, technology also really rely on Intelliscore even more than D&B. So I'm telling you this because I want you to know who really relies on Experian versus D&B. So if you're doing business with insurers, and if you're getting insurance for your company, if you're getting utilities and they're pulling your business credit, keep in mind they're probably going to be pulling your Experian report. The new Intelliscore Plus is over 800 aggregates or factors that affect the score. Scores are assessed on more than 7.2 million businesses in Experian's database. So this is interesting because remember I told you that 2.7 or 27 million is what they actually have. So they have about 27 million records and only about 26% of them have a score, just based on quick math here I did with this calculator. So 7.2 million of their 27 million records have a business credit score. So only about 25% of the companies they have a record for, they actually issue a business credit score for. So Experian first takes a business look at the data segments such as what they call firmographics, which I mentioned earlier, public records, collections, trade information, and they place these into one of 3 different models. They have a commercial model for small, medium, and large businesses. They have the blended model, which I mentioned earlier, and we're going to dissect here in a few minutes, which combines commercial data, business credit data, with consumer data, personal credit data. And then they have the Intelliscore Plus, which is the percentile score, which we just went through. So Intelliscore Plus, like FICO, has a lot of facets that tie into the score. The score is still based on the payment history of the business, how the business business pays, but other factors tie into the percentage of the overall score. So for example, the historical behavior or payment history accounts for 5 to 10% of the score. Okay, current payment status, trade balances, percent of accounts delinquent account for 60% of the score makeup. The business utilization. What percentage of your high credit limits are you using? Do you have a $50,000 high credit limit? Great. What percentage of the high credit limit are you actually using? The company profile, age of business, industry risk, size of business, number of employees account to 5 to 10% of your total score. So just think about this. You fill out your annual report, right? No big deal. How many employees do you have in your company? Well, I've got 5 employees. That number that you're putting there affects your Experian credit score. Most people don't know that. You got to pay attention to what you're putting on those annual reports, because this is where a lot of this information comes from. When you fill out an application applying for credit with a bank, this information gets sent to Experian. That's where they get the information from. So there's a lot of places they're getting this, but it's important to know that how big you are, how many employees you have, these type of things can comprise 10% of your total Experian score. And 10 to 15% of the score is based on derogatory items, collections, liens, judgments, bankruptcies that the business has. So here's a quick look, summary of what I just said. Historical behavior, 5 to 10%. Age, industry size, 5 to 10%. Credit utilization, 10 to 15%. Don't know why my slide didn't have a percent on the first two, but they're all percent. So here you go. So here's just a quick overview of how this is. Your payments, your existing balances are obviously the most important factor. 50 to 60% of the whole score is based on your current payments and your balances. Now this is important to note because the Paydex score looks at your entire score is based on this, payments, whole score. Well, Experian's still acknowledging it's ridiculously important to a point where they're giving 50 to 60% of the entire weight of the score to your payments and balances. And then credit utilization and how many derogatories you have. Let's be honest, the derogatory really ties into payments anyways, comprises 10 to 15%. So if you say, well, how many bad payments you have, and you combine that, now you're saying about 60 to 80% of the whole score is how you pay, basically. Then how you utilize the credit you have is 10 to 15%. How big you are, your past historical behavior accounts for smaller factors of 5 to 10%. So Experian's Intelliscore, when Experian is assigning a business credit score, they take many factors into account. Okay, they look at this as predictive data, and they say this basically helps to determine your real risk. So a lot of factors tie in here. Average balances on your accounts. Average balances on your accounts. So it doesn't put as much weight towards individual balances. It looks at your overall average balance, more importantly for utilization. How recent are your delinquencies? What number and what percent of accounts are current versus delinquent? The percent of balances seriously delinquent. The overall utilization ratio. Here we are again. The overall utilization ratio. Average balances on accounts. So that is one good thing. They're not looking as much as specific accounts that you're overdrawn or overutilizing. They're looking at your average. They're looking at your overall utilization and any balances or leases. Data is collected from credit obligation information, usually comes from suppliers, lenders. These are people that you're giving information to that are then giving it to Experian to pull your credit report, right? So you go into your bank and you go, hey, Mr. Bank, I want like a business credit card. Well, you apply for that business credit card. What you might not know is that then they send that information to Experian, and now Experian has this information that ties in as one of the main things or main components of the business credit score. Legal filings from local, county, and state courts, i.e., public records. Do you have lawsuits against you? Are you a part of lawsuits? Do you have liens against you? Bankruptcies, judgments, tax liens. All that is public information that ties into this legal filings. Okay, a lot of people don't know this either. If you get sued, if you sue another company, your business credit report will reflect that you're actively part of a lawsuit. So it's important to know that. Company background information from independent sources, including state filing offices, right? Here's public reports or annual reports I just told you. That is a state filing office, the Secretary of State. Public records, as we talked about, credit card companies, collection agencies, corporate financial information, and marketing databases. So this is kind of the other section that they get this information from. And combined with data from other sources, including actual trade payment experiences. Okay, so when you pay your bill to Uline, okay, Uline reports the data to Experian. That's exactly what it is. So you pay your bill to a company that reports to the Business Credit Reporting Agency. That is an actual trade experience. Public record, as we talked about, collections, company background, comparative data that places company payment and performance in context with its industry. Okay, so scores are based on a number of factors contained in your business credit report. Number of trade experiences, outstanding balances, payment habits, your utilization, as we discussed, your trends over time, your public record recency. So it's not just that you have these public records, it's the recency, it's how frequent you have these, and the dollar amount. So it's not just that you have a collection that it has become a lien. The question now becomes, how often are you getting these kind of public records? What recency? How frequent are they? What dollar amount are they? All tie into the score. And demographics such as years on file, industry classification codes, of business size. So that's right. Certain industries are higher risk than others. For example, in the lending space, lenders do not like to lend to anybody in financial services. I don't care if you're credit repair, I don't care if you're an insurance agent, I don't care if you're like a mortgage broker. They consider that to be a higher risk class. I'm not saying that's how Experian gauges it, but I'm just giving you an example of how it relates to general lending. So industry classification can tie into your risk. And business size. And if you don't know how your industry is classified, well, those are your SIC codes. So if you're not sure what your SIC code is, you can type it in line. You type it in online. I'm a mortgage broker. What's my SIC code? And it will tell you what your SIC code is. These are worldwide identifiers of business industries. So your SIC code, which did show on the report view I showed you earlier, will tie into how they actually score you. Intelliscore, quote from Experian, calculated by a statistical derived algorithm designed to determine risk based on multiple factors. Here are their definition of multiple factors. Credit, number of trade experiences, balances, outstanding payment habits, credit utilization, and trends over time. Yes, I just broke this down for you individually. Now what I want to do is group it for you. I want you to see they're looking at three main groupings that they're actually using in buckets, and they combine the buckets to calculate your score. Public records, again, recency, frequency, dollar amounts associated with liens, judgments, bankruptcies. The third is demographic information, the years on file, the standard industry classification, as I just mentioned, the SIC code, and business size. So they take all this data that I just told you they use to compile the score, they put it into three different buckets: your credit bucket, your public record bucket, your demographic information bucket. Okay, so that is exactly how they come up with Intelliscore. That's everything you should probably know about it. I broke down, it ranges from 0 to 100. I've told you what the score actually means, what percentage of the score means, where they get their data. Now I've even shown you how they put the data into buckets to actually design or derive the actual Intelliscore. Let's talk about another score they offer called the Financial Stability Risk Score, the FSR. Predicts potential of a business going bankrupt or defaulting on its obligations. Okay, this identifies the highest risk businesses by utilizing payment public records such as severely delinquent payments of 61 to 91 days, high utilization of credit lines, tax liens, judgments, collection accounts, risk industries, high risk industries, what I should have put there, low years in business, and much more. So this is taking this information, this is the heart of what comprises the FSR score, and determining your risk of utter default, of going out of business, of going bankrupt. And just so you know, Equifax, Dun & Bradstreet, and Experian all have a similar score that rates you closing your doors completely and going out of business. This is Experian's, the FSR. So, ranges from 1 to 100. broken down into 5 risk classes, and you see these risk classes right here and their bad rate default rates. Okay, so 66 to 100, very different than the Intelliscore, okay, is a risk 1, and all the way if you're a 1 to 3 score, you're a risk 5. You can have a 5 score on a 100-point scale and only be a risk 4, which isn't bad. But look at the difference here. This is kind of crazy if you think about it. 0.5% on the top tier, jumps up less than 1% for the second tier, jumps up 1.5% here for the third tier, jumps up 7% for the fourth tier. Look at this fifth tier. Jumps up from 10% bad rate default rate to 35%. The difference between having a 3 score and a 4 score is that significant. 25% difference in risk between a score 2 and a score 4. That's huge. So this is exactly why they're in business, is to come up with these kind of analytics to help businesses know, hey, look, the guy has an 11 score. Well, that means you got about a 10% bad rate here with that person. Much different than a 2 score where it could be a 35% risk. Big difference here. Helps business owners make smart decisions. Lenders, credit issuers make much smarter decisions by knowing this kind of information. So the Financial Stability Risk Score is the perfect tool to identify slow pay but will pay accounts and thus set the appropriate deposit or other risk policy. Managing existing accounts is highly efficient since you focus on the bottom 10% of scores where the power of the Financial Stability Risk Score captures 60% of potential risk accounts. This makes no sense. I get that. I'm going to explain it, and it will make perfect sense when you see why they're doing this and how they're doing it. It actually makes excellent sense. This is too small to really see, but this does give you an actual risk, kind of like what I just showed you here, just broken down through an actual graph. So this is where it makes sense. Let me explain to you how this works. The Financial Stability Risk Score is part of the Intelliscore. So what they do here is they say, okay, if you have really high score with Intelliscore, you're stable, very low risk, okay? 82% of the actual is comprised of this. Of all the people that score, like 82% fall into this segment. Medium risk, 2%. Intelliscore Plus, high financial stability risk, low risk. So 84% of the people that get scored here are really low risk. Then you've got this high risk for both events, target segment for deposits. So these people are a higher risk, okay, lower score. Then you get into the very bottom scores of Intelliscore, the lowest score segment. This is what the Financial Stability Risk Score is actually showing you. So what they're saying here is, look, we have this credit score that gauges risk. Then we have a separate credit score which focuses on the lowest credit score borrowers we have and rates them even deeper. Because if you're going to look at this highest risk group to lend to, you probably want to know more information to them. So we're going to build a whole score around that lower group of people so you can see how much risk that lower group even really is. Because some people, this is their business is to lend to the higher risk people. Well, how much risk do you really have here? Well, it's high. But as we've seen here, the risk on the high end of that group isn't as bad as the low end. So they basically are coming in and breaking down the lowest Intelliscore borrowers and giving a separate score so people can even deeper gauge the risk of those actual people. Okay, and here's like a ridiculously deep analytical graph version of how all of this really works out with score. And you can see the approval rates, the bad rates, which actually ties into default rate. You can see score, cumulative score ranges, not much. This is kind of everything we've looked at combined into one graph. But I'm showing you this stuff because your business, decisions are being made on whether or not to give you money based on these analytics, based on the same data we're looking at here. So when you go into your bank and apply for a business credit card and turn down, Now you know why. You know exactly what they're looking at and what calculations they're actually evaluating to decide whether or not to lend you money. So we talked about this earlier, the Experian's blended score. This is combining the commercial, the business credit score, with the personal credit score. A one-page report providing summary information on both the business and the business owner is available. Research shows that a combined business/owner credit scoring model is more predictable than business or consumer only scoring models. And let's look at that a little deeper. So some of the studies they've done showed that when trouble hits a business, blended scores drop an average of 30% over the 4 quarters leading up to the bad event. So here is Experian's validation for why this blended score is so strong and such an advantage to business owners that everybody should take advantage of. Now, again, the beautiful thing about this is they're excluding Dun & Bradstreet. Since Dun & Bradstreet doesn't focus on consumer credit reporting, what I'm about to show you cannot be offered by Dun & Bradstreet. So Experian has done a lot of analytics into this and built this blended score and put so much emphasis on this because they're really trying to stand out above and beyond Dun & Bradstreet with the one thing Dun & Bradstreet can't do, which is combine consumer and business scores because they don't report in the consumer scoring world. Their consumer scores of the owner showed no statistical significance decline over the same period, and the score evaluates the personal information on the owner as it relates to business performance. So this is what they're saying. Look, when we look at our blended score model, on average, we saw a 30% drop to that credit score over the 4 quarters leading up to the bad event. So something bad happens to the business and they stop paying their bills. Well, look, if you looked at the business credit score, you wouldn't have noticed this was coming. If you would have looked at the personal credit score, you wouldn't have noticed this was coming. If you combine the two, then we saw 30% that the business scores dropped in the year before the event occurred. So because we have this blended score, we're able to give a much better gauge of risk because this score is the only score which depicts as far as a year out that somebody's about to have serious trouble. 53% of problems for a business revealed their first signs of credit problems on the business credit reports. 46% of problems showed up on the owner's personal credit report. See what they're saying? It makes actually quite a bit of sense. What they're saying is, look, you got a business that goes into trouble and they stop paying their bills, which is what all of us care about. This is why we pull credit profiles, why we pull credit scores. We're lending these businesses money. We want to know if they're getting into trouble. Well, here's the problem. The problem is that when we look at this, you could tell based on the personal credit report somebody was into trouble 46% of the time before the trouble occurred. If you looked at the business credit report, 53% of the time there were indications there that led you to believe that somebody was about to be in serious trouble. So what they're saying is the result is these blended scores where you combine the two together outperforms consumer scores by 10 to 20% because it combines both these risk factors. And what they're saying is Dun & Bradstreet, your Paydex score, isn't good because what we're saying is if you don't have the consumer data in there, you're not going to know of these 46% of people that had problems on their personal reports first. So this is why our scores have proven to be 10 to 20% more efficient than business credit scores alone. Again, this is their validation for this, and as much emphasis I'm putting on this, it's not a huge deal. Like, not a lot of companies pull blended scores. Most are just pulling Intelliscore, not focusing on blended scores. But I want you to know blended scores exist and know why they exist. Because, again, Experian's own analytics from their own surveys reflect that half the time the problem shows up first on the business report, half the time it shows up on the consumer report. So the only way you really know how risky they are is to combine both. That's their actual verbiage. That's their actual stance on this. So one of more than 500,000 suppliers extending credit, only about 10,000 report to Experian. This is an interesting statistical fact, but why I put it on here is this applies for everybody in the business credit world. If you want to know why it's so hard to build business credit, I just showed you why in one fact. Because a ridiculously small percentage, and I don't know what percentage that is, I'll figure that out. a ridiculously small percentage, I guess, like, let me see if that is a percentage. So 2% of all people that actually extend credit even report to the Business Credit Reporting Agency. This isn't just Experian. This is across the board. So if you have ever struggled with building business credit, it's completely obvious why you have, because 98% of the companies that extend credit in the business space don't even report to the Business Credit Reporting Agencies. And again, this is about Experian, but these statistics hold true for all business credit reporting across all three reporting agencies in reality. Okay, so time data stays on Experian reports. Trade data, 36 months. BK's, 9 years and 9 months. That's horrible. Well, I guess it's not that bad. Public records stay on the consumer reports for 10 years, so about the same. Judgment, 6 years and 9 months. That's good, much better than what you're going to see on a consumer report. Tax liens, 6 years and 9 months. I would be really nice if they would just round this up to make it easy for us, but apparently they're not going to. UCC filings, okay? These are things that are filed basically when you're borrowing money to let other people know that you have outstanding money. 5 years. Collections, 6 years and 9 months. And bank government leasing data, 36 months. So this is how long things stay on your actual business credit report. Good thing to probably know. So how do you improve your score? Well, advice from Experian. Make sure that your vendors are reporting your payments, because the more vendors that report a positive credit history of the credit reporting agencies, the higher your business credit ratings will be. Yes, it might be common sense, but it's actually a very valid point. If you want to offset negative information on your credit report, put as much positive information on your credit report as you can. And this is why I promote building business credit. Get as much positive on there as possible. That way, if you have a negative, it's not going to impact your score. Look, we talk to a lot of clients that come in with a 20 score, 30 score. And the reason isn't because they're horrible. It's because they only have one account or two accounts that are bad. They don't have any other positive. So this is a big problem for people that have issues with their business credit. They just don't have enough positive to offset the small negative that they have. Repair the damage. The quickest way to begin to improve bad credit is to pay off your debts. Decreasing the balance on your business credit cards can have an immediate impact. We already saw 5 to 10% of the score is utilization. I think it was 5 to 10. If you have good credit, requesting a credit line increase can improve your credit limit, again, improving your utilization. So what they're saying is, well, you know, make sure you pay off your debts or get rid of the negative information, repair the damage, and make sure that you manage your utilization. And that's about it. I mean, all you can do to really manage your scores, pay your bill on time, manage your utilization, and something they don't mention here, which is those annual reports. Remember, employees, the size of your company ties into your score, and you control that based on what you're putting on your annual report. I'm not telling you to lie by any means. I'm just telling you do have that within your control. The negatives that lower your score stay on your credit report for 7 years, somewhat. We already saw a breakdown of that. Don't close positive accounts and don't apply for a lot of new credit. We did see that ties into the score. Try to keep your balance at 20% to 30% of your credit limit. Love this. It's the same as consumer. If you want to have a good score, you keep your utilization lower than 30%. Good. We don't have to remember anything different than the consumer world there. So you just want to make sure that you have your balance is low. So again, the main things you can do to impact your score, keep your utilization low with Experian. Doesn't matter with Dun & Bradstreet Paydex score, but does with Experian's Intelliscore Plus. And also make sure you pay your bills on time, dispute any negative items. You can go to Experian's Credit Monitoring and dispute right there. And it's actually fairly good. I mean, if you have items that are negative on D&B and Experian and Equifax, you can check out my YouTube channel. I did a whole webinar on how to dispute this stuff, but just know that you could easily dispute online and it resolves a lot of these disputes. So obviously most of the time to Equifax, right? Because they're important. Equifax really isn't as important as Experian in this space. I'm not going to spend a ton of time on today. Oldest and largest credit bureau in existence today. Ow, man, why am I putting false statements on there? Consumer Credit Reporting Agency. Equifax is the oldest consumer credit reporting agency, not the oldest reporting agency. D&B is. They were founded in 1898. D&B was founded in 1841, so about 50 years before that. But they were founded 70 years before TransUnion, to give you a relation of where they are in the consumer world. Equifax gathering details about marital troubles, jobs, school history, everything in the very beginning. And this is actually why the Fair Credit Reporting Act was created. So again, you'll notice I like history. I like interesting facts. And this is a very interesting fact that the reason the Fair Credit Reporting Act was originally created in 1971 is because these records started to get computerized and they started to be mass collected. And Equifax at the time, literally they would pay their employees more money to get good gossip. So like they would call your neighbor and act to be like your uncle, and they would lie completely. They'd say, hey, it's, I'm Uncle Tom. I'm Joe's, your neighbor Joe. How's Joe doing? I hear there were some problems with him and his wife. This is exactly how they would do it. They would get information about your marital troubles, your job, your sex life, and they would sell this to anybody that wanted to buy it. Like there was no ethical standards at all. They even promoted and paid their employees more that got the best dirt. And so then the Fair Credit Reporting Act was created in direct relation to Equifax doing these things. So their main credit score in the business world is the credit risk score. Okay, the score was created to predict the probability of a business customer becoming seriously delinquent 90 days late in the last 12 months, exactly the same as Experian. Credit score ranges from 1 to 100, same as Experian, with a higher risk being with a lower score indicating a higher risk of serious delinquency, exactly the same as Experian so far. The score predicts the likelihood of a business incurring a 90-day late in the next 12 months, which we just talked about. That's by definition what it means. Score of 90 and above expresses that obligations are being paid as agreed. So what you're going to see here is very similar to D&B's Paydex score. D&B, the main Paydex, the main business credit score in the business credit reporting agency in the world, and Equifax really are scored basically the same. How you pay your bill determines your score. Simple as that. 80 to 89 indicate payments are being made 1 to 30 days late. 60 to 79 being paid 30 to 1 to 60 days late. If your score falls between 40 and 59, you're paying your bill 61 to 90 days late. Scores between 20 to 39 are being paid 91 to 120 days late. Scores between 1 and 19 are being paid 120 days late. Here is again an easy overview of that. Boom, there you go. Paid as agreed. Boom. So this means if you just pay your bills as you're supposed to pay them, you're going to have a good score. Yes, that's what that means. Welcome to why I love the business credit world, because all you have to do is get some initial credit, get it reported to the reporting agencies, and especially with Equifax and Dun & Bradstreet, if you just pay your bill as agreed, you will be rewarded with a good score. It's that simple. It's that easy. You could get a good score in 30 to 90 days just by getting an account and paying the bill. It's crazy. It's so easy to get good business credit scores with D&B and Equifax. So here you go. Simple breakdown. Where you pay your bills determines your score. Simple as that. So they also have a risk score for suppliers. So does Dun & Bradstreet. Dun & Bradstreet has a specific score just for suppliers, just as Equifax does. Known as the Small Business Credit Risk Score for suppliers, the model is designated to help credit grantors improve their risk assessment, reduce delinquency rate when it comes to actual suppliers. The score utilizes unique bank loans, lease information, credit card data, supplier, telco, utility information, public records, firmographic data, from their own database. Very similar analytics or data that D&B and Experian both use to actually gauge your score and your risk. And it ranges from 101 to 816. Like, you never need to memorize this stuff, because when you pull an Equifax report, it will explain this to you right on the report. Not in this level of detail, but it will give you overviews of how this works. So again, if you have like 100 score on this, don't think you're doing good. You're not. You're doing very bad. 101 score. It goes up to 816 with the higher score reflecting the lower risk. And they also have a business failure score. I just went over Experian. They have the same thing, right? So does Dun & Bradstreet. Each of the reporting agencies has a similar failure risk score, which predicts the likelihood that the business will fail or file bankruptcy within the next 12 months, basically. And Equifax, or this model, helps identify businesses that pose a great risk of failure, so suppliers and credit grantors can take appropriate actions. Okay, so what can lower these business credit scores? Well, current collections, liens, judgments, BKs, other derogatory public records on your business credit file, the status, recency, frequency, and dollar amounts of any applicable liens, judgments, or bankruptcies. Remember, it's not just that you have it, it's the status, it's the recency, it's the frequency, it's the dollar amount, especially with Experian. An increased trend in slow payment obligations. An increase in the number of business credit inquiries. These things really affect Experian. I don't know why I put them here for Equifax. I guess I thought I know they would be applicable to Equifax too, but they're really not. These are almost all related to Experian as we saw their score and how it's comprised. Number of trade experiences, balances outstanding, payment habits, credit utilization, trends over time, years in business, SIC code, size of business, other demographic information. So Paydex, Intelliscore, Paydex is DMBs, Intelliscore, small business risk score, the most popular credit scores. Now you know it all, like everything you're ever going to need to know. If you didn't catch my webinar on Dun & Bradstreet, go to my YouTube channel, check it out. I dissect their 5 scores. It's so easy to understand their scores the way I dissect it. And now you get them all. Now you understand how all these credit reporting scores actually work. A positive score can be obtained in as little as 60, 90 days with all 3 reporting agencies just by getting accounts and paying them as agreed. That's all it takes. And paying business bills as agreed will net a positive credit scores at all 3 reporting agencies. It's as simple as that. I just gave you a bunch of hoopla. I'm like, this is a bunch of stuff and analytics of how it all breaks down. But it really breaks down to one thing. Get the credit, pay it as early as you can. You'll have a good Paydex. You'll have a good small business risk score. And since Intelliscore, like 60 to 80% of that score really has to do with delinquency and payment, then if you're paying your bills as agreed, you're going to have a good Intelliscore also. It's the main thing you want to know. So I'm going to go ahead and wrap this up. I don't have time for questions today because I literally am getting ready to jump into another webinar at 3 o'clock in about 5 minutes. But if you do have any questions for me, feel free to reach out. I always like reaching out or helping anybody that I can. So our number direct is 877-600-2487. My direct email is ty@creditsuite.com, ty@creditsuite.com. If you have any questions, anything we can help you with regarding building your own business credit, knowing more about your own business credit scores, feel free to reach out. We're here to help. And again, if you are in more information on building business credit with us or getting financing with us or doing so and offering it as a service for your customers, check us out, creditsuite.com/business credit. There's a webinar you can check out there where I go through all those details and give you everything you'd want to know. So again, I want to thank everybody for taking the time to attend this webinar. My goal is that you always leave my webinars with a lot more information than you came in with. So hopefully now you have a good understanding of Equifax and Experian's business credit scores, how they work, what data is used to comprise the score, the different credit scores they have, the different credit score ranges, and even a pretty good grasp on what you could do within your own power to control your own scores, because it is important. Every bank out there that you apply for business credit or financing with pulls, or apply for any kind of credit for your business or financing, pulls your business credit scores profile, not to mention it's available for customers, for competitors, anybody that wants it. So it's important that you know this and own this and work on building your own business credit profiles and scores. So again, Ty Crandall, thank you very much for taking the time to attend this webinar. Hope everybody has a very good and very productive day. Thanks, everybody.